All right, we should be back fine. I'm back from some technical difficulties. I did check and make sure our connection should be good. Hopefully the community has their the ability to get back into the live stream. That way I can kick back. Yes, WB, we are back. That is correct, Mr. Doug. Welcome back to the Independent Investor channel. I may not even post to the other one. That was a half hour of some pretty good live stream where I was able to get to some of the questions in the group here. But I will allow some of the guys to come back into the group here. I do apologize for that. For you guys that are actually new to the channel, I would love to have the opportunity to actually break down some of the very, very important aspects of being part of this particular movement. And if you're one of the, few thousand subscribers that are part of the Independent Investor channel, I really want you guys to understand what you're part of, okay? I've tuned into a lot of other channels. There's very, very few that I endorse. There's very few that I actually watch and actually enjoy. I'm busy most of the time with my own endeavors. And I really kind of want you guys to understand that if you're finding this channel basically through either referral, I know Teresa had told me that she had referred her friend to the channel. You guys really need to understand and take a step back and say, okay, well, what is unique about this particular offering? And I did kind of a comparison for you guys to understand what is very, very accepted in the investing world with regard to managed situations, managed accounts, and self-directed accounts. All right. And for the folks that have heard through the wind that this exists, or they had no idea that self-directed investing existed, there's probably a very, very good reason for it. And that's really the only negative about self-directed investing is that it takes somebody like myself who actually does it and is very successful in doing so, in telling you, hey, it's okay to do this. You can do it. And for a lot of aspiring people out there, I've met so many people out there that had no idea that it even existed, and the prospect of taking control of their own money was very, very intriguing, and they just didn't know that it existed. And so when you start to kind of look at and say, oh, well, okay, Ryan, what are the benefits of going with, a self-directed program as opposed to a managed program? The list became actually very extensive, and I'm just going to kind of go down this for you guys and let you know from my perspective in the 4 financial planners that I dealt with in my life, what I identified. Each of them had their strengths, but these are what I kind of noticed about how hamstrung I was when I was doing business with those brokers. We are live now. I've come back. I may not post the first one. I do apologize for the technical difficulty, but I wouldn't leave you guys hanging like that. No way. I'm in my workout gear tonight, so very casual tonight, which is the way I like it. But as I went through this list and I mentioned these to you guys, I really want you to separate in your mind, what a lot of your friends, a lot of your family, a lot of your colleagues at work are going to talk about with regard to what they think is the only option in investing. And when you talk about a managed situation, you really need to address the fact that the person who has control over your money is them. Okay, and that can really hamstring you in that if you're putting your head in the sand and you're just giving it to them thinking that you have a strategic advantage with that particular brokerage, maybe they've been recommended to you, you don't necessarily have control over your money, okay? They do. And you may have the opportunity to go in and sit down with your financial planner maybe once a year, maybe once every 6 months, but you really don't have the level of access and control over your money that you can have with a self-directed account. And I thought that was one of the most important things to think about. So if you're one of those new investors and you're coming into the community and you're wondering, what some of the hype is, what the niche of the message is, that's one of the aspects is separating in your mind the difference between, what it means to be self-directed and in control of your own money, as opposed to being with a managed situation and incurring, whatever that program has to offer you. And I'm gonna start to kind of address some of those things and in the differences between the two. The next one you have to be very, very careful with is, if you've ever gone in and sat down with a financial planner, that they have a level of parameters to abide by when they sit down with you and they're recommending to look at your financial plan holistically. And this is where a lot of what I feel like financial planners add a lot of value to, is to look at your life holistically. They may introduce you to and educate you up on, what a dollar cost average program is, how much in your monthly budget you can look to allocate, what your annual income is, what your debt level looks like, maybe what your debt to income ratio looks like, etc. The problem with that is, depending on what financial planner you go and sit down with, you're probably going to be subject to whatever agenda they have. All right, whenever they're sitting across from you. What I mean by that is, a lot of financial planners will get additional compensation for certain mutual funds that they'll recommend to you. All right, so you have to be kind of careful. And if you sit back for a second and say, well, hold on a second, how does that compare with a self-directed account? In a self-directed account, you can use the Morningstar ratings, and you can buy the very best funds on the market. You don't have to be hamstrung with the products that a manager will offer you, and to have that freedom and flexibility, to invest on your own, especially in some of the ETF products that are out there on the market, and not be subject to only be sold or talked into a mutual fund that may have a higher than average expense. And if you just think about it along these lines as well, I've mentioned ETFs as being something that the financial planners really don't benefit from. Now, they benefit if they bring your money into their brokerage house to be considered assets under their management. But as far as making a higher than average, let's say, kickback on the product that they sell you, that's going to come via mutual funds. All right. And when I talk about mutual funds, if you guys are out there and you're part of the community and you own mutual funds, you really need to get into the particulars of each individual offering and identify for yourself what it is you're paying in way of expenses within those mutual funds. And I can contend that a lot of people are paying more than 1 basis point of expense. So 1%. I've seen them as high as 1.67%. And these are funds that are offered through USAA, for example. And a lot of mutual funds that I've reviewed for people, I bring that to their attention, and they're like, wow, I'm losing 1.5 points right off the top. So if I'm making that 8% rate of return per year, that's actually knocked down now to 6.5% when you take into consideration the cost basis of owning that particular mutual fund. So you have to sit back for a second and question, did the financial planner have my best interest in mind when they sold me the product? And I'm going to allow you guys to answer that rhetorical question for yourself. And I think you'll be amazed at what actual answers you're able to come with. So kind of scary, where you start to think about, the mutual fund avenue over here, yes, is a diversified product, but in my opinion, it's very expensive, and it is proprietary in that certain mutual funds will get a higher than average kickback. Whereas over here, you might have the best chance of appreciation, best chance of dividend income over here, but it's actually going to pay the financial planner little to nothing for you to own those assets within a managed account. Therefore, you got to be careful and acknowledge the agenda over here of a financial planner to look at your program holistically. And for me, the most important thing is to get me in the very best product that gives me the very best chance to make the most money in the stock market, period. I don't care how nice you're dressed. I don't care how nice your office is. I don't care. All right. So those are some of the things that I want you to kind of identify and ask yourself, what am I really getting when I opt for a managed account or a managed program? Okay, what am I really getting? And if you're honest with yourself, I think some of the answers that you get are actually going to be quite scary. And start to define for yourself this alternative, because a lot of people don't understand that this alternative over here even exists. Okay, the other thing that I kind of want to talk about as well is it's in addition to that agenda that I talk about. But on the self-directed investing side and having the total landscape to look at in your investing portfolio, you may have $10,000 and you may say, you know what, Ryan, I'm a very conservative investor. I don't want to take that $10,000 and invest it all in the stock market. I want to take $2,500 and invest that in the stock market and keep $7,500 on the side. You know what I'm going to say? I'm going to say, absolutely. If that's what you want to do, then it makes sense for you, and therefore it is the right plan. Okay? Conversely, if you're sitting down with a financial planner and you come in there with $10,000, they're probably not going to endorse that plan. They're probably going to say, invest for your future. The best time to invest is, tomorrow. They'll give you some cliche thing to get all those dollars invested and across the table, where you've just disclosed to that individual, if they listened to you, that maybe investing all of your hard-earned capital isn't what you want. Now, you may justify that down the line, okay? But again, I talk about those two programs in that, just think for a second about what you really want in defining your program. For a lot of people, don't want to be holistically exposed to the stock market. I'm one of them. I don't want all my assets in the stock market. I want as much as I feel comfortable in the stock market, involved in the stock market, and no more. And I'm completely good with that. It's in line with my particular tolerance in meeting my financial goals in the future. Okay, but you really have to question the motives when you sit down and you subject your money to a certain program that may look to just overexpose you to the stock market, even though that might not be in your best interest. All right. So we've got a very good group, robust, back in here again. I may not even post the last one. Again, I apologize for the technical difficulty. I'm actually going to get to some of these questions here. I will probably do another review about my M1 discussion for you guys that were in the first live feed. I do apologize for that, but I would like to offer that for the new folks that come in and catch this live feed at another time. I want to tell you guys what I've done with my M1 strategy. I will be transferring away from M1. I will be putting up a video probably this week. I will probably film it this weekend about M1 going in the trash for me. Okay, it did not suit my needs. But what I did offer, and I will streamline this offering, I did get a subscriber that hit me up via email asking about how it is they could avoid the fees. And they were going back and forth between Robinhood and the M1 Finance. And the Robinhood option is not one that I recommend on this channel. So let's just put that aside. They don't offer retirement accounts, and I don't think that they're the best option to go with initially, okay? Now, M1 can offer you the opportunity to enter into a retirement account right away. They'll allow you to accumulate wealth over time, enter into partial shares of stock, and they will help you in getting to your first $1,000 or $5,000 or $10,000 or $25,000 or $50,000 threshold. And what I said on the old video is that's the most difficult time. And I hate to be frank like that, but you guys really need to understand, I'm not going to blow smoke at the audience and just tell them it's all easy, it's all fun and games. All you have to do is invest in the stock market and you'll make money. That's all a bunch of crap. It's not truthful. It's better for me to just tell you, look, up front, you're going to have the most challenges. You're going to be the most ill-prepared to meet those challenges. You're going to watch your money fluctuate. And it's hard because most of the capital that you've put forward to invest in the stock market when you start is your initial capital. What a lot of people don't understand is the stocks that I'm buying now are self-funded within the account. What I mean by that is I'll take proceeds from one stock to buy another stock. I haven't invested one dime to my portfolio this year. I've just grown it over time. Why? Because it's self-funding. Okay. So, but when you start and you take your first $5,000 and you put it toward the stock market reluctantly, it's my job to sit here and tell you that I acknowledge how hard that is. It's going to be the hardest time. It's not like the hardest work that you do is going to be right up front. And then as it grows and gets bigger, it actually gets easier with time, okay? So it's a little bit of an interesting relationship in that if I can just tell you right away that meeting that first $50,000, meeting the first $10,000 threshold, if you can do that, I will pat you on your back. But $50,000, if we're able to build that account up in M1 finance, save in the entry and exit fees, however much you do it, however many years it takes for you to build that account up, now you're going to have that retirement account built up, that Roth IRA that will be eligible for a rollover into a larger brokerage account. All right. So that was the strategy that I explained on the last live feed before we went offline with our technical difficulty. But I wanted to make sure and answer that and I asked the subscriber if he minded if I could share that with the community. I thought it was really, really important because I get hit with this question all the time when people are asking me, what account should I go with? Should I go with a major brokerage house and incur the $7 entry fee, which I don't want to overemphasize, that if you're investing for the right reasons and you're entering into positions passively, then those trading fees really shouldn't be a disincentive not to invest in your broker of choice. All right. So if you guys really want to go with Fidelity or TD or Merrill Edge, don't let that small entry fee be the determining factor. Okay. I'm just giving you the M1 finance option to maybe circumvent some of those fees if it takes you, 5, 6, 7, 8, 9, 10 years to get up to that first $50,000, which is very, very, it's very feasible that could very well be the time frame that takes. So if you put yourself in there, you're going to enjoy the opportunity to enter into partial shares, build accumulated value in that account at the time when you can transfer over to a major brokerage. Now in Merrill Edge, those trading incentives kick in at around $50,000. So it's going to be that opportunity for you to transfer to a major brokerage house, roll over, cost you nothing. All right, and enjoy some of the benefits of that program. So, guys, thanks for coming back into the group. I really appreciate it. I wouldn't have abandoned you guys like that. I'm very casual, and that's kind of the cool thing about the Independent Investor channel. Nothing's going to change as far as that goes. I refuse to change for anybody. So I do apologize. I wish the computer would just work perfectly every single night, but that's just not the reality of it. So I got to meet the CEO of Mondelez International on Thursday, Dirk Van de Put. Very nice man. That is really cool. Very cool. All my stock picks, I was kind of telling you guys, Mondelez was one of those stock picks that I threw out there. I feel I'm very positive and bullish on the stock. I bought 100 shares of Mondelez, and it will be probably one of those stocks that I recommend for your friend, Noella, who is right below you. When we look to build that stock portfolio, it's really one of those high stock picks that it's got a diversified suite of products that they sell. Just a great company, international company, I might add, based here in the U.S., but sells much of their products abroad and in emerging markets. But I would have loved to have actually talked to him. That's really cool that you said that you put that in the group. Very cool. But I'm bullish on the stock. Intel is one of those stocks that actually worked out this week. It had a nice day today. As I mentioned on the other video before we went offline, I was about as equally as disappointed in Facebook this week. And, it was amazing to see Facebook actually perform a lot less than Tesla. It was amazing to see Facebook get hit like that. So but with that said, I mean, I'm still long Facebook. For anybody that, you know, went into the position, I was saying on the other video that it did break some technical resistance. So, you know, we may have $10 more of downside here. So just be kind of weary of that and make sure that you're holding those shares long term. So he came to our plant. Is this live now? Yes, it is. And I do apologize. Thank you. My investment journey. I've got Lydia Santiago. I would like to say hello to you this evening. I did do a very, very nice spiel for all my new subscribers that have come onto the channel. And I was kind of starting, I'm about halfway through a breakdown of some of the benefits that you can get from the channel. I'm an unconventional channel. I don't run my channel polished. When we do grow and evolve, you know, and we're a lot larger channel, I will certainly look to evolve. Where I do see the independent investor channel going is me actually filming my self-direct help for people, because that is where I feel like I'm in my element, and it's the most enjoyment that I actually get. The ironic part about it is I'm not delivering those services to a group. I'm delivering it to one individual, that I am locked in with them and trying to get to the bottom of how we align an investment portfolio with their specific needs. And it's pretty awesome. I'm humbled at the opportunity to do that. And I know the people that have enjoyed the self-direct help that I've offered to folks on a case-by-case basis. It's not a compensation-based thing that I do. I do it for the good of the person who is receiving that help, and I try to identify those situations where I feel like my help is the most needed. So after about a half hour or 45 minutes, we've really looked to identify what it is we've got for strengths, what we've got for weaknesses, and what we do to go ahead and shore up, you know, and tighten up that program to align with what we need. And I'm pretty good at it. That's where I see the independent investor channel is actually taking those appointments through the channel and actually putting those online to show people how it is that you can really get into separating the gray matter into black and white. And that's what I'm all about. So I'm going to scan through here. Hi, Lydia. Watched your video earlier. Oh, that's really cool. I didn't know you were a channel creator. I'm going to be checking your channel out if indeed you are a channel creator. And I do always make sure and give a shout out to the channel creators who come in here on a Friday night and spend a little bit of time talking about the stock market this week. Please, I'd love to know your thoughts about what you saw this week. I was giving my thoughts about what I thought, and I hate to be a Debbie Downer. I know we just ended this quarter. We enter into a new fiscal year next week, but I'm actually being very, very cautious on this stock market. I did still buy some stock this week. I did sell out of my position in Amazon and Google, both for a profit, I might add. But I'm just being very, very careful and trying not to get too overly aggressive on the trading pillar in my platform. Now, my investment pillar in my platform, in my portfolio, that hasn't changed at all. So the positions that I've had, as well as my fixed equity pillar as well, that has not changed either. But I'm just being very, very cautious with the trading that I do, and I really don't want to get stuck holding the bag here if this does end up getting cranky on us. So welcome to you, Lydia. I will check out your channel if indeed I'm picking up on that. Thank you for coming in and supporting the community. It's very, very cool. I hope you liked it. That's really cool. I look forward to that. When I get done with the live stream, I'm gonna go on and check out your material, but it's very cool to see you. M1 is great for dollar cost averaging. That's, you know, I was trying to really separate for myself, and what I said on the other video is that I know I'm going against the grain a little bit and offering my honest opinion, but I think, you know, I owe it to the community. I did put out my M1 portfolio, which I had every intention of staying with, but as I worked through the platform, I gave it about a month. There was just a lot that I was uncomfortable with. I didn't like the news feeds within my brokerage account. I didn't like what I heard when I called customer service on multiple times. It was almost as if I was speaking with somebody in their their garage. So it just weird hairs on the back of your head. And it's like when you're dealing with people's money, I would rather go with my established broker that I have, a built up relationship with. And that was just the decision that I made. And I wanted to provide that opportunity for people who are just getting involved in the stock market to still realize the many benefits that M1 has to offer, as opposed to Robinhood, which I think is M1 is a much more superior product than Robinhood, just for the sheer fact that, the Robinhood option is just a brokerage account on steroids. That's all it is. And I don't see much benefit beyond that to opt for going with a Robinhood over an M1 account. An M1 account will allow you to start a Roth IRA. And that way, if you were unhappy with the platform, you could actually transfer out of that and just do a rollover into a larger brokerage house someday. So I really appreciate your thoughts. I'm still up on the platform. I think it's cool. It just wasn't good for me. So I'm in the process of actually liquidating those assets and rolling them back into Merrill Edge, where those earnings will be going into a SEP IRA. So use a fiduciary financial planner. I've got Miles Jenkins, who likes to poke the bear. So that's what you just did with me. The unfortunate part about seeking out the services of a fiduciary is that you will pay for that. What people don't understand is that financial planners are not fiduciaries. Very, very few of them are. And I know the people that are going to be offended by me wholeheartedly. And I know there's a lot of good folks out there that if you are a fiduciary and you are operating within the context of having your clients' best financial needs in mind when you make financial recommendations, then great. That's awesome. They're probably offering advice that's more in line with the advice that I offer. And that is to keep costs and fees to a minimum, because that is in fact what, if you're an investor and you're entering into the stock market, you guys understand that 3% over 40 years is going to cost you $600,000 at an 8% rate of return. You're going to end up surrendering $600,000 of your profit potential at a 3% clip. So how can somebody who's a fiduciary sit across from you and recommend that you go into high expense mutual funds? It doesn't equate with me. I'm sorry. And I will never play ball with that philosophy. And I'm one of those guys. I've been around the block. I'm now 41 years old, and I can smell BS from a mile away now. And I'm not going to say that just because you're a fiduciary that you're the end all be all, and therefore you're going to provide me a strategic advantage of the stock market. Okay. I will say this: if you are a fiduciary and you are bound by some sort of oath to have your client's best financial interest be taken into mind by swearing that oath, before you start providing services to someone, I would still contend that you really need to be open and honest with what you're being charged for those services. No doubt about it. You just have to understand what the bottom line is. And those are some of the scary questions that, the masses are naive to ask when they go in and sit down with somebody. And there's a lot of good financial planners out there who are really quick with the tongue, and they're really, really good at, explaining. They're very good at their job. They know finances in and out. They know financial planning in and out. And I think a lot of the times, people get caught up in that, and that because they sound, really, really articulate, that it will somehow justify the fee structure that is put forward for the services. And I think people need to be very, very careful with that acceptance. They really need to be careful, because we've transitioned over the last 20 years in the financial services community, okay, in that we've introduced new products where tell me why you need to have somebody have a fiduciary to invest you into ETFs. Okay, there's a very good case to be made about why you would take a passive approach and not have somebody even necessary to go in there and help you, enter and exit the market to try to somehow outpace the stock market. It's not necessary. Furthermore, I think people are more afraid of single stock ownership than they need to be. I actually think it should be the opposite. I think more people should have more single stock exposure to their portfolio. All right. I really do, with the same philosophy, buy and hold philosophy. All right. So you really, really need to be careful with dealing with fiduciaries. I've been with 4 financial planners in my life. I was friends with 2 of them. Okay. I thought they were very professional. I thought they were very good. They explained a lot. I learned a lot. Okay. In all fairness. But at the same token, I did not understand the level of compensation that I was paying those financial planners for the service. And that, at the end of the day, is kind of the smoke screen that I look to expose, or at least explain on the Independent Investor channel, and just kind of say, look, are we in the same situation now that we were in 20 years ago? And I contend no. I contend that the investing opportunities have evolved so much to justify less needing the services of a financial planner because of the opportunities now, with the information that's available to folks to do their own research, the availability of really having the access, in the palm of your hand, being able to monitor your stocks. If that's what you want to do, if that's your thing, that's my thing. I enjoy it. It's a hobby for me. What that does is it makes it part of my life. Whereas the old school mentality, at least, and I've been there, is to take your, one meeting every 6 months or one meeting every year. And it's like going into the doctor, and getting your financial health checkup. I think we've evolved from those times. I really do. And I think if you can really resonate with the benefits of putting yourself in charge of your own money, the savings on the fee side of the house are going to be astronomical. And if you can really buy into this younger in your life and start with a passive program, just think of the numerous amount of years that you're going to build up over time, where you're not exposed to any fee. Any investment that you make in there, every single dollar is allowed to be liberated and grow unobstructed going forward. And it doesn't have to be subject to these little fees that they get you for within that account. And I'm going to kind of explain a little bit more about that when I talk about comparing the managed situation with the self-directed program. And I really want to define for folks who are new to the channel that very difference, because a lot of people just accept the status quo, etc. There's no, what do you mean you're going to invest on your own? Are you crazy? How could you even think about such a thing? And for a lot of people, they would hear about self-directed investing and they would be like, you're crazy. You have to have a financial planner. And that's not true. It's just not true at all. So I've got Obstinate One here, Ryan. Have you looked into Square? I have, and I like it. I do like PayPal. When I get this transfer complete, I will be entering into a position in PayPal. And I know 1979 asked me if I was going to be investing in CRM Salesforce. The answer is yes. It's number 1 on my buy list right now. I don't have any plans to buy Square. I do like the product a lot. I think they've got a very good niche. I'm just not sure how proprietary that niche is and how easy it is going to be copied. And that's another reason why I'm a little bit skeptical of PayPal, in that, how proprietary is that product as well? You've got every bank coming out now with their own version of mobile payments. The thing about PayPal is that they control 1 out of every 6 transactions in the world. And that's very, very interesting. They've got such a head start on the payment space, and it's a growth name that I want to be involved with. I wish I would have kept PayPal when it split. I owned eBay at the time that it pushed it out. Just another one of those woulda, shoulda, couldas. And I got free shares of PayPal at $30 a share, so I would have tripled my money by now. Again, just some of those lessons to where if you hear me out, enter into some of these good stock positions and just hold them forever. That's really the best advice I can give any new investor, especially along the single stock ownership side of the house. So it's a good question. I don't have any inclination to buy Square. Right now, I'm justifying buying the best of the best right now. I'm really not getting crazy with getting into a lot of growth stuff right now. I'm really playing close to the vest right now. I really am. So want to make that very clear with my group that I'm still exercising my defensive strategy in the stock market, guys, because I know you're talking about how happy you are with September, and I know I'm up. My portfolio is up. It's up huge, but I'm not jumping up and down for joy. I made a comment on Jeremy's video with regard to Tesla going down tonight, and it was basically a one-liner. It said, there is no emotion in investing, period. Because it seems like all of his videos now talk about how crazy things are and blah, blah, blah. And it's just like, it's business, man. That's just the way stock investing is. It's business. It's not personal. You know, a stock doesn't care whether or not you jump up and down if you make money. It doesn't care if it goes down and loses you money. It doesn't care. And that's coming right from the mouth of Warren Buffett. The stock does not care what you think. Scan through here, get to some of these questions. How you been? Long time to no talk. Oh, that's really cool. I can't wait to check out your channel. That's really cool. I've got Obstinate One who says fiduciaries suck. I tend to look at it a little more holistically. I'm not one to impugn the work of a professional, if that's what you call it. But again, I've been around the block a few times, and I think, and I've said it many times, I think in the investment landscape, I think most people are greedy and they're full of crap. That's what I think. That's why I tend to try to protect the integrity of the financial message by doing something a little bit outside the box, and that I don't seek compensation at all. I do this out of the goodwill of what I do, as rough around the edges as it might be. You can turn the channel off at any time and seek out, the services of another channel. I don't charge you a dime. I don't do, monthly memberships that I'm looking to, take money from my subscriber base that I think would be better utilized in a financial plan that you put to work on your own. That's just where I think that those dollars should go. They don't need to go to me. I don't need your money. You do. I've said it many times, and that's typically where I put a lot of the focus on this channel is on you guys, not me. And I find that ironically, a lot of channels out there put a lot of the focus on themselves, as if they're standing at the top of a pyramid, and it's all about them. It's nothing about the subscriber base. And that's not what I'm using social media for. I'm using social media so I can speak my message to multiple people at the same time, if you really want to know the truth of it. So I like this. I'm happy to be part of your community. Lydia, I will be subscribing to your channel if that's indeed what you've got going on. It's very cool. I've met some of the cool people. I've had the opportunity to meet a few other channel creators. I just saw Scribner out in San Diego this week. He did a special with one of the guys out there. It was actually a good 3-part series. I enjoyed the offering. Not really sure how it really benefits normal people, individual people. I don't think entrepreneurship is for everybody. I'm not one of those guys that are down on a 9-to-5 job. I'm one of those guys, I guess, that has a 9-to-5 job, so you can scold me, I guess. I do YouTube on the side. I don't put food on the table with YouTube either. I do it for the benefit of getting my message out there, and that's it. But I'm really glad to have you as part of the community. It's very cool to see you. Very cool. Yeah, I don't know. I think someday we're gonna all be glad that we started this movement on YouTube. I'm one of those funny guys that looks really far into the future, and I actually think the opportunity in YouTube is scary amazing. It's brand new. A lot of people are looking to consume their content through YouTube, and if you've got a good topic and a good niche to offer people, and they can identify with the value that you're putting through the channel, I think you'll gain a base. I'm extremely happy with the community that I have. I'm even more excited about the community that I have that are, the core base of subscribers that actually tune in every Friday, that won't miss a video. That's really the value on the channel. When you put content through YouTube, I don't really think it's necessarily about the size of your subscriber base. That's just my opinion. So Get to some of these other questions here. Growth stocks in a brokerage account. Yeah, you can do that. Again, I want to premise that I think for every new investor out there, you need to go with a retirement account first. Don't opt for that brokerage account if you have a 401k or 403b, a sponsor employed retirement account, something of that nature. You can definitely have that account in conjunction with the individual retirement account. And then if you have a spouse out there, if you and your spouse talk about the potential of getting 2 Roth IRAs, I would definitely do that even before you go with a brokerage account. But after those 2 accounts are established and you can max fund that account and you're funding that 401k to get the company match, now you can talk about having a little bit of an overflow fund. And that's really the only purpose that I see for opening a brokerage account, because any trading that you do in there is going to be taxable, within a year, unless you keep a position for long term. But let's be real. I mean, I trade in my brokerage account, and I'll trade a stock out in a day to make a profit. So, and it's taxable. It's taxed as earnings. I told you guys I upped my earnings by $10,000 last year, just by trading in my brokerage account, and I didn't mind paying the short-term capital gains on it. It was just taxed as earnings, no problem. Okay, but that's because my money is max funded to the Roth IRA accounts that I need a rollover account to take some of my surplus cash and put that to work in the brokerage account as well. So that's why I do that. So pretty cool offering. Thank you for offering that. I'm going to scroll up here to the top, guys. Thank you so much for coming back into the live feed. It's really good. I'm glad you didn't dump the Independent Investor channel and unsubscribe. That's really cool. Thank you. Just a vote of confidence for my group here. I really appreciate it. Thank you for sticking with me. Let me scroll through here, guys. I mainly invest for dividends, even with Robinhood. So you can do that. And I've got Eric Weber here, and I know Robinhood, it generated a lot of, it was one of the top disruptor applications when it came out. And I think the idea of buying stock initially was really intriguing to people. Wow, I can buy stock for free. That's amazing. As I started to peel back the onion and look a little bit further, I was amazed that a lot of people were just looking to start Robinhood as their primary account. And I had to throw a red flag on that, and I did. I've made videos on Robinhood in my catalog. It doesn't mean that the world's coming to an end. It just means that, according to my opinion, you made a mistake in your order. And I know Nate O'Brien really well. He uses Robinhood for the purpose that I think it should be used for, and that's as a long-term brokerage account. But I still contend that for a new investor, you honestly need to look into the prospects of getting your Roth IRA started. And for a lot of people who are young, maybe they're young and they've got a spouse as well. That's 2 accounts right there where you've got $11,000 of potential tax deferred income within what I feel is the best account out there. So opting for Robinhood in lieu of a good retirement account, in my opinion, is just going about it in the reverse order that you should. That's all. It doesn't mean that you've done anything right or wrong. It just means that, in my opinion, you might want to think about going ahead and backfilling. Keep the Robinhood account. No problem. Keep it. But go ahead and start that self-directed Roth IRA account. And I think you'd be very happy that you did. Start funding it on a DCA schedule working forward, even if it's with $25. Maybe pare back on the contributions that you're making to Robinhood, because I'd like to see the max, get filtered in there at $458 per month, $5,500 a year. So that gives you that opportunity to take some of that earned income and get it tax protected. You're going to be glad you did someday. You really are. I just think the benefits of having a better brokerage account as well is going to give you a little bit more in way of research as well. So you're going to enjoy some of those functions within that account as well. So I got Obstinate One right below in case one broker goes out of business, I won't have the issue of transferring 2 accounts to another broker. That is true. Eric Weber says he owns Mondelez. That's awesome. It's a good stock, and it's been since spinoff. Yeah, I got free shares of Mondelez when I owned Kraft at the time when they did end up spinning off. I've timed this really, really poorly. I own Kraft Foods, and I don't know what's going on right now. I'm going to continue to hold the stock because it's trading right now at 6.5 times earnings. I don't know if it's a fundamental problem. They had a very good quarter last time. I'm a little concerned with the fact that most people are pursuing a little bit more healthy options, but these food products, their diversified batch of portfolio with Kraft Heinz and also with Mondelez cannot be overstated. They're both wonderful companies, and I know I'm making a huge dividend, but I'm down around 20% in Kraft Heinz right now. It's a real eyesore in the portfolio, but I have to do the prudent thing and hold it through. I thought we were there. It started to move north above 60. And I thought we were going to be good getting back to that level again, but it just hasn't happened quite yet. But I'm a long-term holder of Kraft Heinz food and Mondelez as well. So thank you for offering that. Obstinate one, as long as you don't have 100K on one account, should be good. Yeah, I don't know. I did buy 100 shares of VTI this week. I did put it in my spouse's account. That was one of those things that I wanted to have a starter base in that account, that of which I did not have. I do have it in my account, but I wanted that VTI exposure for the total market index that I recommend all the time on the show, ticker symbol VTI. So I did end up with a 100 share position. I just bought it yesterday. So hopefully my timing is okay on that. I understand that I'm entering, it's a $15,000 block and position right here. I'm comfortable with that relative to the total overall holdings in the portfolio. But I just didn't feel like I had quite enough diversified exposure. I've got some really good single stock exposure. But I wanted a little bit more diversified exposure there on the base side of that portfolio. So I went ahead and put that block in place there. So I've got Bill Williams. I try to keep dividend payers housed in my self-directed Roth IRA account. Bill, that's an awesome statement, basically. And it's one aspect that if somebody can just sit back and say, look, if I start and buy like an AT&T, which is a buy right here, no doubt. I like General Mills right here. Kraft Heinz food. I mean, if you guys want to pick up and start a new position at 10 shares at 550 at $55 a share right here, I endorse that. Go ahead and go with Mondelez at 40 right here. It's actually come back since I came out with my stocks that I'm buying this week. But I bought 100 shares of Mondelez this week. So I think that's really a smart perspective, and here's why. And this, I want to get back to my managed versus my self-directed, but I want to make it in context of what Bill is talking about there with having dividend payers within the self-directed account. If you have a dividend payer, like let's say an AT&T within a managed account, to set that up on a dividend reinvestment program within a managed account, they're going to charge you for that. All right. And if there's one person in the audience out of the 50 people that are on this live feed right now, open their eyes a little bit at what I just said. It's unbelievable that they charge you for that type of thing. And it's one of those things to where the power heads that be got together and they looked at how they could make money off of people's accounts that were investing in single stock. And they thought, good grief, this is the only way we can do it. We have to charge for this function that we're offering our customers in setting up a dividend reinvestment program. And all the self-directed investors like me out there will tell you that that is absolutely an utter BS. It's crazy. Because I set my dividend reinvestments up in my particular account, it's a drop-down setting. It takes me 2 seconds, all right? But for them to charge you every single month, to set up a drip and make it sound all official as something that it's a product that they're selling you, no, it's not. It's a function and a setting within the account. So to be able to put those a holding like AT&T or Kraft Heinz or a Chevron or a Wells Fargo or JP Morgan in that account and set those up on dividend reinvestment. You have multiple money machines, within your self-directed account that on the beginning you're not going to really notice, but as they start to grow and accumulate and they start to reaccumulate and reinvest dividends and buy more shares of stock with you, just think about all those stocks raising the tide at the same time. And the beauty of it is in the self-directed account, those are all tax protected. That's the beauty of it. All right. So just another one of those differences there. And I want to offer these as well when you're talking about defining your managed program as opposed to your self-directed program. I want you to think about these as well. I want you to think about dollar cost averaging. Okay. Do you guys realize that people are paying around 5 3/4 basis points every time they allocate money to a managed program? That's a fact. It's amazing when I pointed out to people that, if you invested $100 per month and they said, look, we're going to put you in these 4 mutual funds, you're going to actually pay 5 3/4% of every $25 block that goes into each of those mutual funds every single month of every single year of every single decade while you own that account. That it's just unexcusable, and I don't try to sugarcoat that fact. All right, a lot of people just have no idea, and that's unacceptable for me. Okay, if you're going to justify the fees and you're friends with your financial planner because you go golfing once a year, okay, you need to understand that you pay those fees. You have to, okay? You cannot be naive about it. You're not allowed to stick your head in the sand and then come and argue with me on the Independent Investor channel about those fees being justified, okay? They're not. They're not, all right? And that's the dollar cost average program. And there's other ones as well. There's management and maintenance fees. There are yearly fees to own certain accounts like a Roth IRA. Guys, you need to understand that this Roth IRA is your individual benefit, okay? And these financial planning institutions have found a way to attach their fee structure to each one of those individual benefits, right? So they're taking an account that was meant to be individual in and of itself and doing everything they can do to attach a fee over here and attach some feelers over here and attach some feelers to the top of it and basically surround that account with fees. And when you add them all up, a lot of people look at it and they say, wow, 3%, Ryan, what are you complaining about? And 3%, as I've already disclosed, can be extremely damaging over time. And I borrow that from Tony Robbins, but that's the one that really sold me on the idea. And since then, I've validated that 3% figure, and it's not that difficult to get to it. Once you start adding up, if you have 1.5 points with mutual funds as an expense ratio, and you're talking about the annual fees, and you're talking about the maintenance fees, and you're talking about the DCA fees, and you're talking about the dividend reinvestment fees, and every other fee that's part of every disclosure that nobody reads, and you lump those all together, it's easy to really understand why and how you can get to 3% in an expense in a managed account very, very quickly. It's not that difficult. Most people are naive and have no idea what they're paying. All right. Therein lies the reason for the Independent Investor channel. We've almost been gone an hour, guys. Again, thank you so much for coming in and making this a successful live feed. I had a rough week this week, so I always look forward to coming on here and conversing with you guys. I really do. It's one of the most enjoyable things that I do on YouTube. There's no doubt about it. I love to hear your guys' comments and kind of where you're at. So I've got Noella who just says, okay, excellent. Oh, excellent. Thanks. So I'm looking forward to speaking with you on Sunday. I really hope you can be there. I really do. I really think we're making some phenomenal progress, and I'm so excited. I'm very humbled. I would not expect it to be any other way. So I really look forward to our meeting this weekend. So I've been thinking about Intel. I don't have any chip companies. Yeah, so I've got Lydia who's hitting me up with the chip question. I've been really amazed at how they've taken a turn for the worst, all except for NVIDIA. and Intel. I do own 100 shares of Intel. I did enter into the position. People forget the last quarter they had was fantastic. Unfortunately, it gets drowned out sometimes when you're talking about, AIM Applied Materials and Micron Tech as well. And Micron here at low 40s is a good deal. It is a higher growth offering. And when you're talking about chips, if it tells you anything, I will be looking to get a little bit more smaller exposure to NVIDIA because they are the best in the business. But I do believe Intel is that value play that is more attractive to me. And that's indicative of my move to enter into the 100 share position. Honestly, it was one of the counterbalances today in the portfolio, which I do feel like I'm very diversified. I'm a little bit heavy right now, discretionary, which for some reason I ended up being a little bit more overweight and I'm a little underweight right now in technology, which is kind of irritating to me. But I don't own Amazon and I don't own Google, which I sold both of those positions this week. But I think you're going to be fine with Intel, no doubt about it. You're going to be fine. Was just in the mid 50s and in the high 40s right here. I think it closed at 47 today. I think you'd be really good entering into whatever position you're thinking of, as long as it's not $50,000. I don't know what you're coming with. Just be careful, be relative with the position that you take in Intel. But I think a 25 share position, 100 share position, I put you at 4,700 there. I think you'd be good long term on it and just rake in that dividend that they've got. I'm a big fan of Intel. I love the company. That's one of my big tech holdings that I have. So thank you for that question. Good evening, Ray, and thank you for leading us and I on this journey of investing. I don't mind that comment. I don't. But you guys need to understand, and if you guys want to share this with your friends, I encourage you to do so. I'm just a regular fella. I have a regular day job, and I think when I get the most enjoyment out of talking to other normal people. I don't mean that. I mean, what is normal anymore, honestly? I just think a lot of my motivation for doing the Independent Investor channel comes out of some level of frustration as far as what I see in the world now. And I just think there's so many good people out there who need to understand clean avenues of opportunity. They really do. And I think for investing, at least for me, I don't own a small business. I do have my YouTube channel, but we've been going now for a couple years, and I really haven't made any money. That's not why I did the channel. But I think investing for a lot of people can be that satisfaction of enjoying some entrepreneurial involvement or participation. It can be that one thing to where, I'm going to invest in a plan. I may not understand all the ins and outs of it, okay? But I'm going to do it because I understand the importance of seeking compounding interest. I understand the importance of becoming a participant in some of these wonderful companies out there. I understand the importance of reducing fees within my account. Right? It's just that important. Not only that, but I'm tired of all my friends and my family telling me that, I'm stupid for not investing, which isn't true at all. I don't think investing is for someone who doesn't want to invest. It's my personal opinion that I believe everyone should be involved in the stock market, but it should and could be relative to the level of exposure that they want out of the stock market. And that's very, very important. For me, I would rather see somebody invested in the stock market proportionate to their level of involvement and what they want out of the stock market, as opposed to always justifying, not investing. I don't know anything about it, therefore I'm not going to get involved. I'm going to lose all my money. Investing is gambling, I knew a friend one time who invested and lost all their money. Therefore, I'm not going to do it. Right? So I'm here to tell you that, yes, I do acknowledge and I'm very, very humbled at that statement. I am. But I do want to premise this. This is my favorite topic. I do this stuff every day. Okay. So if for no other reason of tuning into the Independent Investor channel, you get a very frequent snapshot in a testimonial. I just had one of my subscribers, it might have been K97, who's one of my good subscribers. It may have been 1979. I'm not sure. I think it was K9, who said that a lot of people charge for showing you your portfolio. And I was like, what? You got to be kidding me. Why? Who cares? I want you guys to understand why I show you my portfolio. I want to show you that because it's a product that I built from nothing. Well, that's not entirely true, right? You guys know that I sold my first car for $3,000, split the money, right, and put $1,500 into one account and $1,500 into the other account. Now, those accounts have grown over time to approaching $100,000 each. All right. That to me would be some of the validation that I would expect to see if I was a new investor coming on. In my 20s, I expected that. I expected that if I was going to tune into a channel and watch about investing, I'd be like, what do you bring to the table, man? You know, what have you done? What mistakes have you made? What mistakes can I avoid for myself? Would you mind telling me those things? And so that's where I feel like a lot of the value is on the channel. Norman, thank you very much. That's a very kind statement. It's really some of the payment that I receive on the channel when I hear comments like that. So thank you. I very much appreciate it. I'm humbled by it. Again, I feel like the majority of, if not all of the success on the Independent Investor channel will be built upon the successes of each and every individual that come in, take and deploy the message through self-directed investing. And that's what I consider an empowered investor. That was our goal from day one. So I'm going to go ahead and scroll down here, see if I'm getting some of these questions here have popped into the end. I'm not worried about losing my money, and it's covered by SIPIC. I just don't want to have to roll over 2 accounts if my brokerage goes out of business. Fair enough. David Mathis, glad you're back, Ryan. Thank you. And I apologize. No big deal. I can't make the computer work. So I've got Officer Towers, man. I had a great discussion this week. Very loyal subscriber. I've got, hey, Ryan, I hope you took a position in JP Morgan. I took a position in JP Morgan when I told you I took a position in JP Morgan. I'm down 3% in the position. I could care less. Who cares? I bought 20 shares Monday, and I bought 25 more shares yesterday. So it did go down today to 112. If you picked it up on that entry, I think you got a killer entry. All this garbage about overseas banking system affecting our strong financial system is just beyond me. That's where it came from, and I don't really care. So my financial exposure right now, American Tower REIT is considered a financial. Go figure. I don't know how they figure that, but Citigroup, JP Morgan. And I've got a small token position in Wells Fargo. I think I've got 25 shares of Wells Fargo to enjoy some of the huge dividend that they pay. So that's my financial exposure right now. And then you guys know I have Blackstone Group as well as part of a limited partnership with the Blackstone Group. So Becky, I've got on the line here. I was looking at Intel today too, Lydia, but I already own AMD. Becky, if you don't mind, I'll offer my opinion. I'd like to know what your entry point on AMD is. Certainly, if you're up, you've got a very good accelerated. It's up 100% this year. So it has absolutely been an excellent stock buy. I don't put AMD and Intel in the same category yet. Intel is kind of the established, been there, done that type of company, very value, very established. AMD is actually winning market cap market share, from Intel. So I think you could do okay with either one of those. But I might consider taking some of your AMD profit if it's a nice profit and rolling some of those into a value play. And that way you've got a nice growth stock in AMD that's winning share, and also have that value play in Intel. So, you know, just kind of my thoughts on it. My friend Ryan Scribner, he bought AMD at $10. That was a home run for him as well. Anybody who bought it, you know, in the low teens or even the low 20s, quite frankly, has made, you know, a lot of money. I would just be kind of careful because, you know, I watch companies like AMAT, which is a very well-run company. I watch companies like Micron as well, another great company, and they're suffering. So I'm not really sure what the deal is, but AMD is a great company. They're doing very well. You might want to think about maybe taking some profit here, just an idea. All right. Very nice work here, independent investor. Really good stuff. Eric Weber, thank you so much. I appreciate it. Lydia Santiago, my investment journey. I like this. I'm happy to be part of your community. Thank you again. Cruise down here. Like that, help one person at a time. Yeah. So, and another thing, you know, about being on the YouTube channel, you know, there's some drawbacks to just putting out a 5-minute video. It's so one way. I feel like, unfortunately, you have to buy into some of the cliche to make it go kind of big. And what I said on the video before we had that technical difficulty is, you guys understand, you know, I did the 5 stocks I did this week. It was relatively a pretty successful video for me. If I get 1,500 views, I'm stoked. You know, that's awesome. You know, I'm not looking to put I don't even know what a viral video is. I don't know. I've asked Scribner how to do it, and he tells me how to do it. And I'm just like, I don't know how the hell you do it, but he's crazy. But I don't really care, because, you know, those videos are seemingly the most popular videos to put out. And I think you get the least amount of value out of them. Like, conversely, the video that I just put out, where I've got over 600 views on the philosophy and fundamentals of investing, 5 tips to help an investor, that's a way better video. I'm sorry. Like, I just find it funny how people justify consuming certain pieces of content, and they don't want to consume other pieces of content, I'm assuming, because it's longer. And they don't want to sit for 15 minutes, but they will sit for 5 minutes, you know. They've got the attention span of 5 minutes, and that's it. That's basically all you have, which is, you know, it's true via analytics. I've got about 8 minutes to win somebody over, but I don't really care. I offer those pieces of content because I know there are people that watch that and do benefit from I have 25 years of experience. So I condensed those into a 15-minute video. I won't apologize for putting that content online. So I love the stock market. When it's up or down, I invest when I can. I'm slowly increasing my current positions. And that's really cool. I'm so looking forward to kicking over and checking out your channel. Again, if there's anybody in the community here, I would assume that everybody subscribed to the channel. You need to kick over and support that channel. I just think this investing community is a real special thing. It's awesome. I know there's people out there that look to YouTube to put that information out there. And I will just say, if you're one of those content creators that take that into consideration, I have channels out there. If you are one of them, you will become one of my endorsed channels, and I will add you to my channel for sure. I do not mind helping out in the least bit, but I will review your content and make sure that your motives are in line with mine. I really will. That's one of my criteria. And you'll notice that's why some of the more popular channels on YouTube are not ones that I endorse. I can't do it, because I feel like at the end of the day, when the content is consumed and deployed, which I believe we have a responsibility when we put content out there, to put content out there that we're assuming that somebody is going to take and act upon. All right. If you don't think that, I think you're kind of naive, you know. And I see a lot of content creators putting content out there that they just throw it out there for entertainment, and I think people are subject to being hurt by that information. So I really look forward to reviewing your content. Again, thank you for coming on. It's awesome. I must have a dial-up internet because mine is still buffering. Bill, sorry about that. The Cox Cox Communication, that's cool. That's a good stock, actually. Um, Eric Weber, 1 billion plus serving of Coke sold worldwide. Long been a favorite of mine. Sailed through 2008 downturn. Boring stock, but consistent dividends. Yeah, so I was tired of watching Coke for a long, long time. I owned Pepsi. I've owned Pepsi for well over 5 years. Right now, I've got about a 48 share position in Pepsi. I do own a 100 share position in Coke. So I bought both of them. I've split them between the two Roth accounts, and I've been very, very happy. I got a pretty good entry on Coke in the low 40s. So yeah, I've got it set up for dividend reinvestment. I'm glad to own the company. So very cool. Thank you for that offering. I appreciate it. I had a terrible enter until last week. I wasn't poking a bear. I was giving an option. Yeah, no, I know you were. Absolutely. Thank you, Miles. That's very cool. I've yet over the life of the channel for 2 years, I've interacted a few times with a few financial planners, and that's why I made that comment that I did, who this was the very topic, and this was the topic of actually a very heated argument that I had with this particular financial planner, who I might add was not an associate with a larger brokerage house. It was kind of an independent financial planner that was charging a lot of money, who was declaring themselves as a fiduciary. And needless to say, I still to this day contend that I won that argument hands down. Because that individual would not disclose what it would cost over time when they rendered services to someone. And that was the root of my argument, because I provided those statistics back to that individual, and they failed to acknowledge that that was the case. So very cool. Thank you for doing that, Miles. Actually, it's a very, very good topic to talk about, generate some discussion. So channel to the Jake Jones channel live feed this week. I think he tries to help the average investor. Thank you. I appreciate that. That's really awesome. I think there's so few channels out there. I think a lot of people would say that that's not the case. I think everybody's got their own little niche. There's a few of them that I really, really like that I don't endorse through my channel. But some of the major folks I can't stand. Makes me want to throw up every time I turn it on. So I mean, I can't even watch a few seconds of it anymore because I think it's so absurd. But hey, listen, that's what it is, and everybody's entitled to produce the content that they want. If people are going to consume it, then so be it. You can't fault somebody for continuing to pump out a bunch of material that doesn't mean anything over YouTube, as long as somebody's going to watch it. So, so guys, we're going to start to wrap it up a little bit. I'm going to try to get to the end of this and make sure I got to all of these questions here. Eric Weber says single stock, diversified exposure, and dividends. Yes, I tend to offer this as well. If you do enter into some single stock, that's great. I really highly encourage you to look into the potential of having some diversified assets in there as well, to kind of give that counterbalance and that barometer of the stock market. When the stock market goes up, you're going to enjoy that holistic rise in the tide, and then when you have those single stocks in there, you've got the potential there for above average wealth acceleration or wealth creation in there with single stocks. So I do agree with that. So let me try to get to some of these here. G stands for go exit. Yeah, no kidding. It's been a rough hold. I don't personally own GE currently, but it is on my watch list only. I own GE. Some of the parts analysis is a $100 billion company. I will remind you guys that I owned GE all the way through this downturn. So it is worth it for me to hold the stock just to prove a point when it does end up turning around, and it will. It absolutely will. I have no doubt. Sold off GE a while ago, had been holding it since 2008-ish, so did make some money on it. That's really cool. Hope you guys are right about Sears and GE going up someday. we'll see. Get some kickers. Yeah, so that's kind of the end of it. I've kind of got to all the comments here. I really appreciate you guys tuning in. Again, I apologize for the technical difficulty this evening. This was kind of a casual discussion about the stocks. I do really want to thank the channel creators that came in this evening as well. I'm kind of scanning through and making sure that I got all of these questions answered. Thank you again, Lydia Santiago. I will be checking your channel out after I kick offline here. Really appreciate you coming in and support, and I will do the same for you. So thank you guys for coming in here. I will sign off. Good luck this week in the stock market. Please heed my advice in summary a little bit. When you're looking at deploying new capital in the stock market, make sure that you're taking a defensive mindset. It's the defensive mindset in a stock market that is at or hovering around record high levels. That is going to be the philosophy that makes sure that you don't get overexposed to the stock market. All right. It's the most important thing that you can answer for yourself, because if you're excited about investing, that's great. Get invested. Okay. But just make sure that you're able to invest for the long term and not overexposed to the stock market insofar as incurring a downturn or a correction in the stock market and panicking your way out of the stock market. So that really is my advice that I will leave you with this evening. Guys, have a great weekend, and we will see you again next Friday. Thank you so much.